Year-to-date lows are down roughly 16%, and around the middle of June it bottomed at around 170 and has since climbed ever so slightly again. During the last week, it has jumped twice, the day that Home Depot released their earnings and the same day after where they released their own earnings. Lowe reported a bit of a mixed result for Q2. The profits came in stronger than expected, even though the revenue fell short. You can see here that the company managed to beat the earnings per share by 7 cents, even though they missed the revenue by 680 million. Also, comparable sales decreased by 0.3%, and there was also some concerns about inventories because at Home Depot the inventories had jumped by over 30%, so it was really nice to see that the inventory for Lowe's only grew around 11% from the prior year, as a big contrast to Home Depot. So let's jump in a bit into the numbers behind Lowe to see if there is a good bargain to be had. So right now, Lowe is trading at a PE non-GAAP forward ratio of just over 16, and that is compared to the 5-year average of 18.24, so that sounds really nice. It could be there is a small discount to be found here. There isn't any book value calculated here, so I won't go deeper into that. And if we look at the dividend stats, they are also looking like a real dividend growth company because you have a fairly okay starting yield at 1.95, payout ratio really low at 16%, 5-year growth rate of 18.77%, and you have this massive dividend growth for 58 years. If we jump into the financials, you can see the revenue is growing from 68 billion to 96 billion in January 2022, and the last trailing 12 months it's at 95 billion, and they are expecting, as you saw earlier, to end around 97 billion. If we scroll down, we also see that the net income is improving from $3.4 billion in 2018 to around 8.5 for the last 12 months. But obviously, one of our main focal points is that free cash flow to pay the dividends. So if we look at the cash flow statement, you can see cash from operations is also increasing from $5 billion in 18 to 10 in 22, and for the last trailing 12 months we are at 8.5, so they can obviously feel the headwinds that are damaging them right now. But if we look at the capital expenditures, they are looking quite okay. They are sitting relatively fixed compared to the previous years, so I wouldn't be too concerned about that. If we jump into the balance sheet, you can see here that they do have quite a lot of cash on hand, around 4 billion of the latest report. As mentioned earlier, the inventory is rising, so it sits around 12 billion in inventory stock right now, which is quite a lot and can obviously hurt them in the future if they need to put a lot of stuff on sale. If you scroll down a bit in the balance sheet, you can see that the total debt is around 33 million and the net debt minus cash obviously is 29 billion. One thing that's really nice to see is that the total shares out on filing date has decreased massively. So you can see here it's gone from 825 to 795 to 754 to 717 to 661 to 339. So they are massively buying back shares every quarter. But that was how some of the numbers behind look. So let's take a look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And to do that, we obviously have our usual models, so we can take a look at them. I won't spend too much time going into detail on each of them. You can pause the video if you want and look closer. I'm expecting a growth rate of 10, and that is a bit on the slight conservative side compared to what analysts expect, and that is obviously for the coming period. So around here we get 248, and if we go into our discounted cash flow model where we take the free cash flow and discount it towards the future, I apply a growth rate again of around 10%, which is compared to the average growth rate of 28. I think that's very conservative. I get a fair value of 321. If we take the numbers from their dividends and put them into the dividend discount model compared to industry average VACC, we get an intrinsic value of 305. And for the last one, if we do the multiples valuation where we compare with Home Depot, Floor & Decor Holdings, LL Floor Holdings, we get a stock price of around 253. So if we sum that up from the grams, the discount cash flow, the dividend discount, and the multiples valuation, we get an average intrinsic value of 282. At the current price for 215, it appears there's already a good deal to be had, but obviously I would like to apply a margin of safety, and for a big company as Lowe's, I could probably do 20 or even lower. which give me an acceptable buy price of 225. And if we only apply a margin of safety of 10%, we get 253 as an acceptable buy price, which means that there appears to be a massive undervalue right now for Lowe. And this is a stock that I'm very interested in buying, so I would have to do more research about that to determine whether or not this should be a possible buy or not. So let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear it as well. So thank you so much for watching this video, guys, and please don't forget to like and subscribe to the channel.